America.
Donald Trump has named former PayPal executive David Sacks as AI and crypto czar. In a social media post, the president-elect said Sacks would focus on making the U.S. a world leader in both fields. He says his administration will ensure, quote, the crypto industry has the clarity it has been asking for. Trump once labeled such currencies a scam, but embraced the sector during his election campaign. His victory has seen Bitcoin surge on bets that the new administration will be friendlier to digital assets. This week, the top cryptocurrency broke through the $100,000 level for the first time, though it later dropped back. It's up around 50% since Trump's election win. Sacks was formerly chief operating officer at PayPal. Among other things, he also founded the business social network Yammer. He was an early advocate of cryptocurrencies, saying in a 2017 interview that Bitcoin would revolutionize the internet. One analyst told Reuters that Sacks was seen as a strong backer of crypto with a history of investing in tokens besides just Bitcoin. Earlier in the week, Trump named strong crypto advocate Paul Atkins to run the Securities and Exchange Commission. That added to optimism for the sector, with the U.S. financial watchdog hitherto seen as unfriendly to crypto.
Shell and Norway's Equinor will merge their British offshore oil and gas assets into an equal joint venture. They announced the deal on Thursday. Based in Aberdeen, Scotland, the venture is expected to produce over 140,000 barrels of oil equivalent per day. The new entity will become the British North Sea's biggest independent producer. But Shell told reporters that there's no intention to conduct an initial public offering. The ageing British North Sea basin, where production started in the 1970s, has seen a steady exit of oil companies in recent decades as production declined. The British government's decision to impose a windfall tax on North Sea producers, following a surge in energy costs in 2022, has further put pressure on producers to reduce investment and exit the basin. Equinor is currently developing the Rosebank oil field, one of the last known major oil reservoirs in Britain, while Shell is developing the Jackdaw gas field. A range of exploration licenses are also thought to be part of the transaction. The companies expect completion of the deal by the end of next year.
Germany's Christmas markets are a traditional way to forget about the colder, darker months. But in recent years, they've had to keep a close eye on costs when deciding whether to buy up mulled wine and bratwurst. The costs for festive treats at traditional Christmas markets have hit record highs in Germany. In old and new markets, Germany's favourite Christmas beverage of mulled wine now sells for a record €5 per mug in Berlin. That's a 50% rise from the pre-pandemic €3.25. Michael Roden is a chairman of the Berlin Association for Traditional Festivities.
One problem, of course, is the costs we have all around us. The energy costs, the administrative costs, the market prices. Everything that has happened in the economy today, and that prices are getting higher, and the production of individual goods has also become very expensive.
Organisers have blamed the elevated costs on high energy prices and staff shortages, among other factors. It's led to traders getting creative and unwrapping new strategies to keep attracting locals and tourists alike. Their ideas include all-inclusive tickets and special themes. Fabian Lau is managing director of events firm Faro Group.
We've always said crises make you creative, and in the middle of the pandemic, we realized that all our indoor Christmas parties would be canceled. We said, then let's just have a Christmas market instead. However, we also said that it was difficult to calculate, so we would try it out as an all-inclusive concept, and that worked out really, really well.
This Christmas market in Berlin offers all-inclusive tickets starting at just under €30 or $31 for those willing to go after 8 p.m. and during the week. Buying a ticket means visitors can get unlimited mulled wine and as many German specialties as possible without worrying about the costs. It's proved popular with visitors, as Lau said demand for the tickets is extremely high. They've sold more than 1,000 daily, and 90% of them have already been bought up for this Christmas season.
U.S. stocks ended lower on Thursday, with United Health Group down sharply and technology shares easing. The Dow shed more than 0.5%. The S&P 500 and NASDAQ each lost about 0.2%. The declines come just one day after all three indexes notched record closing highs. Patrick Kennedy, founding partner of All Source Investment Management, believes now is the time for stock market investors to take a bit of a breather.
So when it comes to market valuations, we think things look a little frothy right now, especially with the S&P trading at 23 times next year's numbers. There's still a lot of opportunity underneath the surface, in our opinion. We happen to like software, we like biotech, and we like cybersecurity right now. Those are the three big sectors we want to see our managers be exposed to. But other than that, at the index level, we think this is a good time to take a look at a pause.
Among individual movers, shares of United Health Group dropped more than 5% and were the biggest weight on the Dow and S&P 500. Shares of Cigna and Molina Healthcare also fell. Health insurance companies are reassessing the risks for their top executives the day after the murder of United Healthcare CEO Brian Thompson in Manhattan. United Healthcare is part of United Health Group. Shares of Synopsys fell more than 12% after the chip design software firm forecast fiscal 2025 revenue below Wall Street expectations, in part due to a slump in China sales. And cryptocurrency and blockchain-related stocks lost steam after Bitcoin fell below the $100,000 level after eclipsing it for the first time ever earlier in the day. MicroStrategy, the largest corporate holder of Bitcoin, ended down nearly 5%. Investors now turn their attention to Friday's monthly non-farm payrolls report for clues on the Federal Reserve's next policy moves.
Chinese automakers have ramped up exports of hybrid vehicles to Europe, and they plan on sending more models to the key market. The move exposes the limits of the European Union's electric vehicle tariff scheme. It aims to protect its auto industry from cheap Chinese imports, but the tariffs don't apply to hybrid cars. Analysts say they could see major brands like China's top EV maker BYD continue expansion in the region. Some manufacturers are also shifting production and assembly to Europe to lower costs around tariffs. One leading analyst expects China's hybrid exports to Europe to grow by a fifth in 2024 and even faster next year. EU tariffs of up to 45.3% on Chinese EV imports came into effect in late October. The bloc wants to counter what the European Commission calls unfair subsidies that helped create spare production capacity in China. Data shows the anti-subsidy investigations have led some Chinese automakers to change their European strategy to focus more on hybrid exports. Hybrids have gained in popularity as buyers consider them an affordable compromise between all combustion and all electric. A Chinese trade body calculates hybrid exports to Europe more than tripled to 65,800 units from the same period a year earlier, between July to October. It reverses a trend of sliding sales until earlier this year and in 2023. Exports of plug-in hybrids and conventional hybrids made up 18% of China's total vehicle sales to Europe in the third quarter, double the number of the first quarter. The proportion of EV shipments fell by 4% during the same period. Some analysts believe the trend is likely to gain further momentum. They say China has stepped up its export drive to address overcapacity at home. The US and Canada has put 100% tariffs on Chinese-made EVs, which makes Europe a more obvious outlet for Chinese automakers. The European Commission did not immediately reply to a request for comment on rising hybrid imports from China. However, rising exports from China could trigger intense price competition in Europe's hybrid vehicle market. But some experts caution Chinese firms are likely to tread more carefully for fear of causing another round of EU tariffs.
Europe's struggling industries are bracing for a new gas price shock over the coming winter months. Colder weather is depleting stocks and competition with Asia for liquefied natural gas has intensified. The prospect of reduced Russian supplies is also looming. Since the energy crisis of 2022, when gas prices peaked at nearly €350 per megawatt per hour, dozens of firms across Europe have closed factories and cut activity. Many are maintaining reduced demand and lower manufacturing activity, with negative implications for Europe's sluggish growth. EU gas demand is 17% below the 5-year average, observed during pre-pandemic years. At the same time, gas prices are at their highest level in over a year, and analysts predict they will rise further. Nervousness about the expiry at the end of the year of a Russian transit deal to supply gas to Europe via Ukraine has helped to drive buying. Data from Gas Infrastructure Europe shows EU-wide gas inventories are 85% full, some 10 percentage points lower than a year ago. Analysts say that makes the current winter already feel uncomfortable. To try to safeguard supplies, the European Commission last week increased its storage filling target. That could potentially add to the upward pressure on prices. Current EU prices are nearly 5 times higher than US gas. A survey by Germany's Chamber of Commerce in August found that high energy prices and a lack of reliable energy supplies were hindering industrial production. It's also prompting some German firms to consider relocating abroad. In France, industries expect to operate at 70 to 80% of capacity this winter due to the high energy prices. That's according to the president of a French industrial lobby.
Bitcoin catapulted above $100,000 for the first time ever on Thursday, a milestone hailed even by skeptics of the digital asset. The historic surge comes as investors bet on a crypto-friendly incoming U.S. administration, with President-elect Donald Trump a day earlier nominating pro-crypto attorney Paul Atkins to run the Securities and Exchange Commission. The appointment of Atkins, a former top SEC official who has advocated for deregulation, could provide relief for a crypto industry that has chafed under President Joe Biden's hard-charging SEC chair, Gary Gensler. Dan Ives is global head of tech research at Wedbush Securities.
Deregulation clearly is going to happen. A new SEC chair that looks like pro-Bitcoin. Very bullish in terms of this dynamic. So I think a big piece of what we're seeing here is a Trump bump, but I don't think it stops because I think Trump can be pretty aggressive when it comes to Bitcoin once he's in the White House.
Bitcoin has more than doubled in value this year and is up more than 50% in the 4 weeks since Trump's election victory, which also saw a slew of pro-crypto lawmakers elected to Congress. Analysts say the growing embrace of Bitcoin by big investors this year has been a driving force behind the record-breaking rally. But Mark Chandler, chief market strategist at Bannockburn Global Forex, sees Bitcoin's rise as part of a bigger social and political movement.
The ground that we've been standing on is moving, and these shifting sands, and in this kind of turmoil, we don't know really what's going to be the winners, what's going to be the losers. And I think that in this, and when you're rejecting it, like many of the elections, especially in the industrialized countries this year, have rejected the incumbents. And so I sort of see Bitcoin as part of this rejection of sort of the established values and not just the values of society, but really of the elites.
The total value of the cryptocurrency market has almost doubled over the year to hit a record of over $3.8 trillion, surpassing the value of Apple, according to data provider CoinGecko.
Britain approved a multi-billion-dollar mobile merger on Thursday. Vodafone and Hutchison's-Three UK were given permission to create the country's biggest mobile operator. Regulators had warned the deal could push up prices, but they accepted a pledge by the two companies to invest in 5G networks and offer protections for retail and wholesale customers. Britain's Competition and Markets Authority, or CMA, said they now believe the merger is likely to boost competition in the UK mobile sector. It added Vodafone and Three must agree to implement the proposed measures. The approval follows a demand by Prime Minister Keir Starmer for regulators to put economic growth at the front of their thinking. It also marks a major shift in the CMA's belief that 4 operators were needed to ensure competition and keep consumer bills low. Vodafone and Three have committed to spend $14 billion to build a better 5G network serving 50 million customers. Regulators believe the investment should drive competition between the 3 remaining networks. They also think it could eventually deliver a better service for customers. Vodafone will own 51% of the combined company, and it will have an option to buy the remainder after 3 years subject to certain conditions. Vodafone shares were up slightly in early trading.